This is Chapter 15, Discussion Number 2, Functions of the Federal Reserve. The Federal Reserve takes care of several different functions within our economy in order to ease us through a lot of the different ideas of how our economy works. Now, what the Federal Reserve, as an additional function, also helps clearing checks. If you write a check from one bank to another bank, how does the money get from point A to point B? Well, a lot of times banks will keep accounts with each other, especially local banks with each other, because a lot of checks are going around, and it's a lot easier to just keep accounts in each other so that they can subtract and add to those accounts instead of having to do a whole bunch of back and forth. But let's say that you're writing a check to someone out in California. If you lived in Pennsylvania, that would be those banks are not going to keep accounts with each other. So the Federal Reserve helps the money go from point A to point B and make sure that all the banks take care of all their funds and that goes through the Federal Reserve. Another thing the Federal Reserve does is that it is the fiscal agent of the federal government. This means that the entire savings and checking of the federal government is in the Federal Reserve. The federal government is the only client of the Federal Reserve. All of the federal government's money is in the Federal Reserve. The Federal Reserve does not do any checking account or savings account for any other entity, person, corporation, or anything in the world. So that's where all the money comes from. Also, the Federal Reserve supervises all the nationally chartered banks in the United States. They set up the regulations, they send out the bank examiners to make sure that those banks are keeping true to the regulations and that they are not acting recklessly with the depositors' money. Federal Reserve will also hold reserves for the local banks. Remember, they have to keep 10%. Some of that money the banks just let the Federal Reserve keep for them to make sure that they're on the good and straight and narrow. Also, they set the reserve requirements, which we'll be discussing in the next discussion. They also supply the paper currency. If you look at your money, you will see Federal Reserve Note, which means the Federal Reserve provided it. They regulate the money supply, which is the main part of the next discussion. They also set standards for very specific consumer legislation. For example, what does it take in order to get a mortgage? What do you have to do in order to substantiate that you can pay for a mortgage? What kind of person can the bank loan money to? What do they have to tell you? For example, truth in lending. The bank has to explain, when you get a mortgage, sometimes the document's 20 to 40 pages long, and the bank is required in the truth in lending to make sure you understand the entire contract, to know the exact costs that are expected for you to pay in order to get that loan. Not only to get the loan, but how much is it going to cost throughout the entire payments of the loan? Can you pay it? All that stuff has to be established because of the regulations that have been set up by the Federal Reserve. Now, the Federal Reserve also, as we talked about in the first discussion, establishes the monetary policy of the United States. Now, there's a whole bunch of categorization for this, but we can essentially put this into two big ideas of what is it for monetary policy. And essentially, how difficult is it to get a loan? Remember, money is valued based on how difficult is it to get the money. Now, we get money primarily by working and getting paid a wage. But if you need to borrow money, this is where monetary policy has a huge influence on what's going on. So, economists qualify monetary policy into two basic categories: tight money supply and loose money supply. Now, if the Federal Reserve is tightening the money supply, that means that they're increasing interest rates. Again, if interest rates are higher, it's more expensive to get a loan. And if it's more expensive, less people will be borrowing money. They also might have higher credit requirements. On your credit report, you have a high number, which means you pay off your loans well. You have a high income. You have a high potential to continue that income. If you don't have those, then maybe you won't be able to get a loan because the banks will be less likely to loan you money. Now, a tight money inflation, its primary purpose is to reduce inflation, that prices will not go sky high, and to control the amount of what's going on in the economy. However, The other side of it is called the loose money supply, lowering interest rates, lowering the credit requirements, which means more money is going to be loaned, more money is going to be available. Businesses are going to be able to borrow money inexpensively to expand. And so a lot of people look for loose monetary supply, loose monetary policy in order to increase the economy of the United States. And so these are different ideas of how the Federal Reserve actions can control and affect what goes on in the national economy. This concludes discussion number 2, Functions of the Federal Reserve.